Generally, mutual fund is an investment which is collected from a group of investors for a pool of money which their purpose is investing in securities. It issues redeemable shares. On the other hand, unit trust is a long-term investment. Trust means confidence of someone we can rely on. Trust, in other words, is also a finance term where a third party is brought into the transaction between two people, which by the conditions, the banker will be the settler, the father will be the trustee, and the son will be the beneficiary. Unit trust can be divided into two categories, which are open-ended funds and closed-ended funds. Open-ended funds buy and sell units on a continuous basis, hence allowing investors to enter and exit as per their convenience. The units can be purchased and sold even after the initial offering period. The units are bought and sold at the net asset value declared by the fund. Unit trusts are open-ended and are divided into units with different prices. These prices directly influence the value of the fund's total asset value. Being open-ended, whenever money is added to the trust as an investment, more units are made to match the current unit buying price. At the same time, whenever units are taken, assets are sold to match the current unit selling price. Closed-ended funds means that the unit capital of closed-ended funds is fixed and they sell a specific number of units. Unlike in open-ended funds, investors cannot buy the units of a closed-ended fund after its initial offering period is over. This means that new investors cannot enter, nor can the existing investors exit till the term of the scheme ends. However, to provide a platform for investors to exit before the term, the fund houses list their closed-ended schemes on a stock exchange. There are some differences between unit trust and mutual fund. A unit trust invests in a relatively fixed portfolio of investment which are held until the trust is liquidated at a predetermined date in the future. Investors who want to trade shares of a unit trust before it matures can often do so on the secondary market. Unlike a mutual fund, unit trust share prices in the secondary market may be priced above or below the net asset value of the trust's actual holdings. Mutual funds offer very diverse portfolios and actively trade the securities in the portfolio. A mutual fund might have 20, 30, 40 or more securities in one portfolio. When a unit trust gets established, it also establishes its own termination date. For example, a unit trust has invested in 30 years bonds, but once the bonds mature, the unit trust terminates. Additionally, a unit trust makes an initial public offering just like its closed-end company counterpart. The unit trust issues a fixed number of shares during this public offering. Mutual funds create shares based on demand, giving them almost an unlimited number of shares available to trade. Unit trust does not have a board of directors or utilize the services of an investment advisor or investment managers. Mutual funds have professional investment advisors and managers sitting at their helm. With a mutual fund, its manager invests in assets according to a stated set of objectives. Shares are issued and redeemed on demand at a specific net asset value that is determined at the end of each trading day. Besides, there is no fixed number of shares for mutual funds, which means that if many people want to buy in the fund, the company will issue more shares.
Created using Powtoon.